Just a few weeks ago, the China authorities sent a clear signal that they wanted to revive investor confidence. Investors, come back to the country because we scared you away back in 2021 with our sudden crackdown on the internet sector. At the same time, their main focus is to revive the economy, revive the markets. But on Friday, surprise, we're starting again. We're cracking down on the internet sector, specifically the gaming sector, stopping people from spending too much money on games. Well, that's the final straw. For that reason, I'm done. I sold all my Tencent shares and I'm not touching any more China stocks. Yep, so on Friday, a top gaming regulator published draft rules that broadly is designed to clamp down on practices that encourage players to spend more money and time online, because the China government is worried that all their young people are not working, they're playing games every day, they're addicted, they're not getting married, they're not having children, and it creates a lot of social ills. So they encompass caps on the amount that each player can spend within a game. You can't spend more than this amount on a game. They ban rewards for frequent logins and forced player deals, and even a prohibition on content that violates national security. So with this recent move, it's clear about one thing. The Chinese government places the interests of their people above business interests. And of course, that's very good for the people. That's a very responsible government. But that's not good for business owners, right? And as people who buy shares of stock, as a shareholder, it's not good for shareholders. So for this reason, I decided to sell all my Tencent shares on Friday and take my loss like a man, and to eventually exit all my China positions over time. Now, the good thing is that Tencent makes up less than 1% of my entire investment portfolio, and all my China stocks make up less than 4% of my entire investment portfolio. So yet, although my China stocks have bombed for this year and the last couple of years, although my Tencent stock, I cut loss at 30% down, but again, my portfolio is looking still pretty healthy year to date as of Friday. Up a 46% return on this portfolio, my first portfolio, up 42% return on the second portfolio. And in terms of dollar gains, I'm up over $2 million year to date. And that is why what's really, really important is about portfolio diversification, because shit will happen into some of the businesses that you own. And it's important that even if shit happens into one or two or three stocks, you can still do very, very well because you diversified in the right way. So the majority of my gains this year was driven by my top performers, right? Meta, Salesforce, Microsoft, Nvidia, Palantir, Amazon, Google, and that makes up for some of the boo-boos this year. I mean, besides China, I had some other boo-boos like my Disney boo-boo, stupid mouse, I sold that as well, right? Estee Lauder boo-boo. But I'm holding that for now. Now, I know some of you are saying, Adam, I told you so. I told you 3 years ago you can't trust the Chinese government. They will screw you. And this is nothing new. They intervened with businesses before. So why didn't you get out before? Why you get out now? Well, I gotta admit, yep, I was an idiot. Okay. Well, actually, I kind of thought, let's give them another chance. Maybe they'll learn from their lesson, but no. Well, again, it's clear. It's kind of like I said, investing in China stocks is so tempting because it's so undervalued fundamentally, and it's such a big market. It's like having this really attractive girl that you want to date, right? But she's got this crazy father that once in a while comes into the room and kind of slaps you on the face. And yep, got slapped on the face 3 years ago, but then the father said, I tell you what, you can date my daughter, come back. And I thought, okay, maybe the father's changed, but now he's come back to the room and slapped me again. So you know what? Although the Chinese girl is really attractive, she's really cute, I'm going to go for the Ang Mo girl, the Western girl that has got a sleepy father who won't do shit. Now, those of you who have been following me for quite a while will be pretty surprised because you know that it's very, very rare that I would sell an investment. Now, of course, for trading, I buy and sell every day, But for investing, I very rarely sell. Even if the stock drops 20, 30, 50%, I don't sell. Usually I buy more. For example, when Amazon, Meta, Salesforce, Google dropped 50%, Meta dropped 70%, I didn't sell. I kept buying more, right? So I very rarely sell. But when do I sell? That's really, really important. I think a lot of people, they don't know when to sell a stock. When it drops, they're like, do I hold it? Do I sell? Or do I buy more? And the answer, it really depends on why the stock price dropped. Now, if I can summarize on this chart, there are many reasons why the price of a stock declines. You have got non-company specific reasons. So sometimes the stock of a company drops, it's got nothing to do with the company, but it's got to do with some macro reason, right? Some macroeconomic reason or geopolitical reason like wars, recessions, interest rate changes. Or you could have like a bear market. So in a bear market, everything drops because of sentiment. Whether good companies, bad companies, they all go down. Like during the COVID crash, even companies like Microsoft and Amazon, they were growing their revenues and profits. They went down as well, purely based on this bear market sentiment. Or simply because of sector rotation. Like for example, this year, most healthcare stocks went down, even though some healthcare stocks are making a lot of money because healthcare was out of rotation. Same thing with consumer staples, they were out of rotation this year. And industry-specific news. Again, drug stocks, food stocks were down this year because of some industry news like Ozempic that's helping people lose weight. So people think people lose weight, they eat less food, they go for less medical procedures. That's why those industry stocks drop. Or sometimes it could purely be market manipulation by market makers and algos. So when a company stock drops because of all these reasons, I don't sell. In fact, I buy more because these are all temporary reasons that will be resolved over a couple of months or maybe even 1 or 2 years. And it's a great opportunity to buy when it's really, really undervalued. Okay. Now, sometimes the stock can drop because of company-specific reasons. Something happened to that company. Okay. So, for example, the company misses earnings estimates or lowers its forward guidance. Like recently, Nike reported earnings better than expected, but they lowered their forward guidance. Stock price dropped. Same thing happened with Viva Systems. Oh, by the way, I used the proceeds of my 10-cent sale to buy Nike because 10 cent went down, Nike went down. So I thought, okay, let's sell this one and buy the other one, right? Now, another reason is that a company could go through a cyclical slowdown in demand for its products and services. For example, last year we had a cyclical slowdown in advertising expenditure. That's why Google and Meta went down last year because of the cyclical reasons, right? Or temporary bad news, like a product recall, lawsuit, sex scandal, right? Or major shareholder forced liquidation. This happened to Archegos a couple of years ago when they had to force sell their position, and that caused a lot of stocks to drop because of this big shareholder that was forced selling the stocks because of margin calls. Or simply manipulation by market makers and algos. So again, all these are reasons that a stock drops that is company specific. But for all these reasons, same thing, I don't sell. In fact, for all these reasons, I hold and keep buying the stock. The only time I will sell a stock is for reason number 10. Reason number 10 is when there is a structural problem. Now, what does structural mean? Structural means long-term permanent problem that hampers the business model or that causes the business to not be able to grow to its fullest potential over the long run. Okay, so example, the economic mode of a company deteriorates, or there's a permanent disruption to the business model, or there's a permanent change in consumer behavior towards that product. To me, these are all reasons to sell. So in other words, to summarize, when a stock drops, it could be because of fundamental reasons or non-fundamental reasons. Now, non-fundamental reasons means nothing changed about the revenue and profits. Now, in that case, clear, out whole, and buy more, okay? But if it's a fundamental reason, which means the sales and profits actually drop or will drop, then I ask myself, is it a short-term cyclical or seasonal reason, or is it a structural or permanent reason? Now, if it's a short-term reason, seasonal, cyclical, I would buy more shares. I'll take advantage of the short-term weakness, right? But if it's a permanent structural reason, then I think that's a clear reason to get out of a stock. So again, my rationale for not wanting to invest in China stocks anymore is not because of the weak economy. It's not because of the weak macroeconomics. You know why? Because macroeconomic reasons are short-term, they are cyclical. When an economy is weak, it'll become strong later on. So that's not the reason why I'm not touching China stocks. It's because of the structural policies of the government that are not pro-business, which I don't blame them. I'm not saying they are wrong. They just choose to be more pro-citizens and pro-society than pro-business. And I respect that, right? And of course, the Chinese are not the only ones. Europe is the same thing. I would say Europe is not pro-business as well. And that's why Europe's capital markets, Europe's businesses have always lagged behind the US, because the US has always been pro-business. They put business ahead of its citizens. I'm not saying that's good, all right? Of course, it's bad for the citizens, but as an owner of a business, as a person who's looking at, maximizing my returns, of course, I want to invest in an environment where it's pro-business. The same thing when I buy real estate. I'm a landlord. I want to buy real estate in countries where they are pro-landlord, and I avoid countries where they are pro-tenants. It's all about making money where money is the easiest to be made. Now, some of you would be asking, but Adam, could there still be some China stocks that could do very well, that could outperform like Pinduoduo and many other Chinese stocks? Yes, of course. There are definitely going to be some Chinese stocks that will do very well in the future. But to me, I would rather just focus on US stocks because of one word called predictability. To me, the most important thing about investing is about predictability. And if I'm investing in an environment where the government can suddenly come up with a law without much oversight and suddenly disrupt the entire industry or business, then I find that very, very unpredictable, because there's no way to know when your company will be next. Again, this is not something new. They did it in 2021, but they're doing it again. So at that time, yeah, I saw that coming, but I thought, you know what? They are going to change. It's going to be a short-term thing, but it looks like it's an ongoing thing that's going to recur in the future. So for that reason, I rather invest in businesses that are very predictable in a predictable environment. That's why, to me, the most important thing is investing in a business with an economic moat. Because when a company has a wide moat, it is more predictable. It's not easily disrupted by competition. All right? And does Tencent have a wide moat? Does Alibaba have a wide moat? Yes, they do individually as companies. But if they're in a market environment that could disrupt or destroy that moat overnight, then it doesn't matter whether it's got a very wide moat. Besides predictability, the second most important thing to me about investing in a business is its growth potential. I want to invest in a business that has got a lot of growth potential ahead. But again, if the government is not pro-business and they place limitations on how much the company can grow, limitations on its revenue and stuff like that, then to me it doesn't make sense to stay invested in those businesses. I'd rather sell those businesses and reinvest in other businesses where the sky's the limit, right? Nothing is restricting their growth. Nothing could disrupt their business model. So again, it's all about predictability and growth potential in the future, okay? Now, so finally, some of you will be asking, Adam, are you going to sell all your China stocks right now? No, I'm not, okay? Because short term, the market is very oversold and some stocks are still very, very undervalued. So I won't be surprised that short term, we will get technical bounces. And if I want to exit my positions, I don't want to exit at a low point as far as possible, unless something really is affecting that company in particular, like Tencent, okay? But generally, I hold Chinese ETFs, some of them. I hold Alibaba, I hold Ping An Insurance. And again, individually, they are still good companies. They are growing their revenue, they are growing their profits, they're undervalued. And right now, they are oversold, they are undervalued. So yes, I want to get out of them over time, but not at this price. Because remember that when a stock is on a downtrend, it doesn't drop in a straight line, right? It goes like that. It goes down, then wave up, down, wave up, down, wave up. So after a drop, and right now, again, if you take a look at the market, Chinese markets, we're right now very much somewhere here, okay? So if you're not in need of the cash, if you're not, desperate, doesn't make sense to sell there. Again, unless something's affecting that company in particular, right? Which could, of course, go even lower, right? But generally, I would say I want to wait for a bounce. Wait for a bounce where I get a much better price to exit. So finally, let me give you an example of Alibaba. Like I said, individually, Alibaba is growing revenue, profits, free cash flow. It's very, very undervalued. And of course, in the long run, their growth may be limited. In the long run, there is unpredictability because you never know, big brother or father could come and slap the shareholders of Alibaba. And you never know, right? But of course, I'm not going to sell here, Like my last valuation of Alibaba is about $204 to $237 intrinsic value based on its free cash flow, its growth. So currently at 75 bucks, it's like freaking cheap. Okay, so I'm not going to sell here. I'm going to wait for a bounce. And if you look at it technically, there is a kind of like a swing low here, swing low, and it could be doing a bit of a double bottom pattern, right? So again, there could be a technical bounce soon, or at least next year. And if I want to get out, I want to get out closer to at least the valuation of the business, which, yeah, there's still quite a bit of upside actually. It could double to 140, in fact, could triple to about $200, where eventually I'm going to exit the position. So the whole idea is I'm not saying I'm going to sell all my China stocks right now, no. Okay, but over the long run, I'm not going to hold it. In the long run, I would liquidate and invest in businesses that are even better, just as great, in a more pro-business environment. All right. So hope you enjoyed this video. If you have, do leave your comments in the section below, because I know you guys have different thoughts and stuff like that. And of course, those of you who have been very, very anti-China and you're going to say, yeah, I told you so, Adam, you're an idiot. Go ahead. Tell me I'm an idiot. Tell me. I deserve it. Okay. See you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.